It's not a myth that we can pay off our mortgage in 15 years.
Yeah, 15 for sure. But I mean, 7. Yeah, 7's a bit controversial. You see that one
I'd like to see that
bit.
example. There's a lot of interest. That's off their standard repayment. They've paid off $10,000 in the first year.
Why does this one get a revolving credit? Why is this client not getting one? So many different people have so many different ideas of the best method of debt reduction. But we're going to bust some myths today. We're going to give our opinion, the blueprint opinion. Hello guys, and welcome to the next episode of the Blueprint Podcast. I'm here with my co-host Rory, and today we're tackling some tough subjects, ones that we really like to talk about actually, because there's a bit of controversy on how to actually pay your mortgage off faster. So many different people have so many different ideas of the best method of debt reduction. And some people think it's investing, some people think it's hammering down your mortgage as quickly as you can, all these different methods you could incorporate. But we're going to bust some myths today. We're going to give our opinion, the blueprint opinion, and we're going to talk a bit more about those methods and explain them with some numbers too.
Yeah, absolutely. And I think that the key message that you've just made is that there's some promises out there about certain numbers and timeframes for paying off our loan. And what we want to get into today is practical steps that people can take to make a real difference on the amount of interest they pay the bank. I think a lot of people will be interested in this because we're talking about first home buyers here in our examples, and they could be any age, people in their 20s or 30s, and there's a scary number next to that loan balance, and it's usually 30 years.
That's right.
Which could seem like a lifetime away.
Yeah.
So this will be really interesting, Dan, and I know you've got some great examples to work through. So the first step, what's our first example of paying off mortgage faster?
Yeah, so I suppose the best place to start is we'll build a bit of a case study and we'll work around that. So I've got a bit of a plan. Let's say we've got a couple, let's call them John and Jill. They've got a mortgage, 800K balance, and their property's worth around 1.2. So let's say they're maybe 3 or 4 years into home ownership, or they had a big deposit, so there's a bit of equity there. And the reason for that is so I can show all the different options. Large size mortgage that they're trying to pay down as quickly as they can.
Cool.
Okay. So this is the client we're going to work off, and we're going to address three of the main methods. So there's 3 main methods that you can consider to actually pay you off mortgage faster. So we're not doing any baity, headlines. We're just giving the truth there. So the first one is actually paying your mortgage off faster, doing things like keeping your repayments the same when the interest rate drops, or increasing your repayments, which we'll take a look at. And the next one is the revolving credit method. Instead of making lump sums on your mortgage, you can actually retain some of your cash and offset your mortgage, reduce your interest costs, and in the long term, pay less interest and pay it off quicker.
Brilliant.
And the next one, which is a bit more controversial, is investing, buying an investment property, holding it through a property cycle, and using the proceeds to pay off.
Yeah, nice. And as we go through them, I'll pick your brains a bit, and we can get into the pros and cons of each and the risks with each, if any. So let's start with revolving credit.
I think it's a good one because when you're doing the insurance for our clients, you can often see the structure we're setting our clients up with. And often there is a revolving credit in there. And always ask me questions, why does this one get a revolving credit? Why is this client not getting one? So that's another thing to touch on before we get into this. This is very general financial advice. We're speaking to John and Jill's situation, not speaking to everyone. If you want specific financial advice, you need to chat to your financial advisor, disclose all your information so they can give you really accurate figures. But we're speaking to a couple of the methods we've seen people have success, or our clients have had success, and us personally, and what people are actually talking about when they say pay your mortgage off faster. So here's the first example. We've got the $800,000 mortgage for John and Jill. Throughout this example, we're going to use a 6% interest rate. So throughout interest rate cycles, very often interest rates are less than 6% over 30 years. By using 6%, I feel we're being conservative in terms of how much this is actually going to cost. We're starting off on a 30-year loan term. You can see their repayments weekly are $1,100 on the 30-year loan term. So if they didn't change a thing, if the interest rate stayed the same throughout the whole loan term, they'd pay their mortgage off in 30 years.
30 years.
We're also going to make an assumption that outside of the weekly repayments, Every year, John and Jill are able to save $20,000. So they can save 20K every year, and they want to put that towards their mortgage. Now, John and Jill have also told me that they don't want to fully commit every single dollar towards the house. They want to have access to credit or their cash so that they can redraw it for either renovating the property or just to have some security for the family. They don't like the fact that every single dollar is going towards the house, there's no savings. So that's why we're going to take a look at revolving credit. We're taking a look at the next sheet now. This is after 12 months. So they've had a successful 12 months. They've paid off their first 10K of the mortgage. Principal interest table loan, that first 12 months is pretty sad.
There's a lot of interest. That's off their standard repayment. They've paid off $10,000 in the first year.
It's off the standard. You pay off 10K on a loan of that size. So you can see here, they've paid off for 10,000, but they've also saved that 20,000. We've put 20,000 into a revolving credit facility. You can see here, loan type revolving credit.
So that's at the end of year one. I've saved it, it's gone into my bank account, and now I've created.
And now you sat down
credit
with Dan and said, I want to make a revolving credit.
I'm ready.
Oh, yeah, hit me.
Yeah, okay.
And we set you up on your anniversary. Let's say you're fixed for 12 months. That's the date we'll do it.
Okay, sure.
12-month fixed. We've put in $20,000 and now we're offsetting that 20K. So on this $20,000 of mortgage, remember it's still mortgage, it's just called a revolving credit now. You're offsetting it with $20,000. So it's essentially like a savings account or an overdraft account for your mortgage where you're not paying interest on that money. You can see if the 20K wasn't in here, there would be a repayment. You can see how this just went up here to 117. But because it is in there, you're fully offsetting that amount. You're not paying interest. Important to note, revolving credit products have a higher interest rate. We've just assumed a 1% higher for this exercise. These aren't real rates right now. We're just looking at the example. A couple great things that happened here. We're storing that money at 20,000 and we're paying less interest overall because that's 20K that we're not paying interest on. So the main fixed balance has actually reduced to 770. But Rory, here's the magic. We've kept our repayments the same. We're still paying the exact same amount, that 1,100, just over, and the loan term has decreased. So remember, this is after end of year one. This is beginning year two. This loan term should say 29 years, but for the same repayment, you're actually paying off the mortgage in 27 years.
That's brilliant.
You with me?
Yeah, I'm
incredible, right? So now we've set up our clients in a position where the repayments are the same. They've got 20K reserves if they do need it, but that money's working in their mortgage.
That's fantastic.
So it's a really good opportunity for them to now double down and focus that same amount they're paying weekly on the principal. So it's a good result here, but let's see what happens in year 5. Let's say they do the exact same thing for 3 years. Every single year they're adding 20K in savings. What's that going to look like? Let's jump over the next sheet. You can see here, now the revolving credit's $80,000 because the last 3 years, they've added $20,000 to the revolving.
So 4 years, they've saved $20,000.
Yeah.
Put it in the revolving credit.
Exactly. Now, what's happened in the last 3 years? They've paid off an additional $43,000. And they've also saved $20,000 each year, like we mentioned. So they've paid off an extra $43,000 of principal. Throughout the whole time, they've kept the repayments exactly the same. We haven't had any benefits or privileges of lower interest rates. We're assuming the exact same rate. Now, you can see the revolving credit here is $80,000 in cash reserves sitting there offsetting their mortgage. But also, the loan balance has come down to 667 because every time that 20 grand comes up, they're chiseling off a piece and putting it in their revolving credit. So now with the same repayment, they're on a 20-year loan term.
After 4 years.
You can
So
see
that's 20 years remaining, so that shaves 6 years off, is that correct?
Yeah, that's right. So now they're year 5 and they've got 20 years left versus where we started at 30 years. But now they've still retained the revolving credit so they can use that if they need it. So there's a bit of power there in terms of the cash available. They're not fully committed, but instead of having it in a savings account, that's a lower bearing interest rate. Obviously, you're paying more on your interest than you're earning in savings. They've got it sitting there in their revolving credit.
Brilliant.
So it's pretty powerful.
So this is really good for people who have got some excess cash that they want to be saving.
Yeah.
They might ordinarily have put this into a savings account before they were homeowners.
Yeah.
But they also want the advantage of having access to those funds for a rainy day,
Yeah.
for an emergency,
Yeah.
whilst gathering interest savings at the same time.
Because that's what happens commonly. People will start paying off their mortgage. They say, look, we feel like every dollar is going towards the house and we're one emergency away from being in a bit of trouble. Well, you can have that rainy day fund, but you can actually have it working for you.
Yeah.
So this is a great way. You can see how if we just kept going through this every year, we're going to pay this mortgage off in about 15 years compared to the standard 30 years just by using this method. Obviously, the more that they can save, the more that they can increase that revolving credit, the quicker you can pay it off.
So it's not a myth that we can pay off our mortgage in 15 years.
Yeah, 15 for sure. But
15 's
I mean,
doable.
7. Yeah, 7's a bit controversial. We see that one
I'd like to
talked
see
about a
that
bit.
example. What are the drawbacks here, Dan? Like, so you've got to be disciplined. Have you seen any traps where people have set this up and then come out worse off
I definitely have.
through lack of discipline?
The thing is, we sit here with our coffees and say this looks fantastic. But at the end of the day, this life doesn't work out exactly how you plan, right? You might go down to one income in the household, get made redundant, or you're just not able to save. And so if you can't hit those goals every year, then it's not going to work in your favor because obviously the revolving credit rate is higher. You actually risk paying more interest. So you're exactly right. It does require a lot of discipline and frequent review and financial planning. If you're doing this every 12 months and keeping an eye on it, most likely it's going to work as long as you've got that discipline. But if some things happen and you just let a couple of years go by and then you've got this revolving credit that's got no offset in it, it's got no cash offsetting it, then yeah, it's actually not a beneficial method.
Yeah, absolutely.
Brilliant. So that's our first method. Now we're getting into the one which I think is your favourite. It's the very controversial one.
The
of
7-year method.
the coveted 7-year method. This one is the one that we see advertised a lot or people are referring to. Buying an investment property and using the capital gains of that property to pay off your unoccupied mortgage.
Nice.
Now, initially when I say that, as an insurance advisor who's dipped into property investment, what are your thoughts about that? Do you feel like it's feasible? I mean, does your brain bring up some risks to that? What do you think?
Well, I think there's a lot of factors like your horizon, your investment horizon. Property markets are currently down, depending on when you bought. Again, it depends on your horizon. So there's risk in property. I think if you zoom out over time, it's a pretty safe bet. It has been, but there's no guarantees.
Well, that's why the question marks come with the 7 years, right? Because if you read information about property cycles, they're longer than 7 years. The premise of it is just suggesting that it's putting too short of a time frame, in my opinion, on how long it actually would take to achieve something like this, using your investment property to sell and then pay off your mortgage.
We could manufacture an example and support the 7-year method, but there's a lot of things that would have to go right for that to come true. Yeah.
Timing the market becomes a factor, which in investing, you never, ever, ever want it to have anything to do with timing a market. You know, you time in the market is what you want. If you're trying to depend now on external factors, other than letting inflation and cycles do its thing, then you're setting yourself up for disappointment.
Yeah, sure. And then the risks of having multi properties and then increasing interest rates and serviceability risk and all those things are pretty high if we're trying to go for a rapid method of paying off our loan.
We love property investing here at Blueprint, but we love it long term. So we've got the Blueprint property investment calculator here, and we're going to go through a scenario for this method. So using an investment property as a vehicle to pay off your mortgage quicker. Let's go back to John and Jill. Remember that they had a bit of equity in their property. So you can use your equity as a down payment for a mortgage, and that's what they've done in this case. So they've fully financed a property for $650,000. That's a $650K mortgage. Once again, the interest rate's 6%, and we've done an interest-only mortgage, which is a $750 weekly mortgage that they're paying. In terms of rental income, what I've tried to do is put something sort of middle ground. In Auckland and all the major cities, you struggle to get a 6% rental yield, you would struggle, but regionally you can get much more than 6%. So we've tried to find a nice middle ground between capital growth and your cash flow, which is always the two pillars of property investing that you're battling with. So we've got a 6% rental yield, which is $750 per week that we're working off. I've got the expenses here. You can see the generic expenses: insurance, $1,600, rates $2.5K, and annual maintenance of $4K. We've also got a property manager in there as well at 8%. So what do these numbers end up working out at? If you're holding this property long term, your cash flow is going to be negative every week, negative $215. Okay, so that's you topping up out of your own pocket, $215 a week to keep this investment property ticking along. How does this affect you over a year? Annually, it's $11,220 negative cash flow. And over the 10-year period, it's a negative $112,200. So you've got to be mindful of the opportunity cost here. $112,200 could go towards paying off your mortgage quicker rather than investing.
Sure.
We could go to investing in other opportunities. There's always opportunity cost that we have to be mindful of. But we're putting it into property now. So what we've done over this 10-year period is we've also assumed a capital growth rate of 4%. Now, there's arguments for a 3% capital growth rate. There's arguments for a 6% capital growth rate. Once again, we've assumed 4% to be conservative. So after 10 years, holding this property, this is the projected value, $962,000. Pretty nice profit, right?
Good gains, yep.
So let's play this out. How does it actually look if we use that to pay off our mortgage? So the balance of your mortgage, say if John and Jill just had the same mortgage and paid it off a 10-year term, the balance will be $670K. Now, let's say they use the net profit from the sale of their investment minus agents' fees and lawyer fees would be about $272K. They use that to pay off the $670, make a lump sum payment. So their loan's going to reduce to $398,000. You can see it here, $398K at 6% interest rate. Now, what happens after we do this? If we keep their weekly repayment the same, roughly the same at just over $1,000 a week, they've reduced their loan term to 10 years to pay it off.
So 10 years.
10 years, yeah.
Total term 20 years.
Total term 20 years from this exercise. There's no paying off your mortgage in 7 years unless you do a highly speculative capital growth property development. We're not even going to entertain those numbers. It's just not going to happen.
We need multiple
houses and to take on more risk, which for that time frame is just not advisable. If clients are in a position to buy many investment properties, that's great, but we would never recommend it for just a period of 7 years.
Yeah, it's an achievement to get a first home.
What we want to look at here is look at that capital growth rate, and over time consider the rent from that property would keep increasing. The property would be cash flow positive at some stage because of how inflation is going to keep causing rents to rise. It's nice that in 10 years you can sell it and pay it off, but imagine what you could do in 20 years if you held that property. The extra 10 years for John and Jill, they'll be able to sell the property, pay off the remaining mortgage and have cash at bank, or be in a position to invest again.
This was costing them $11,200 a year versus the revolving credit example was $20,000 a year. It's a leaner example in terms of additional cost.
It actually is. So the numbers, and I've used some pretty conservative numbers in terms of maintenance, property management fees, those sorts of things. Pretty realistic in terms of what we're seeing with our investors right now and what's costing them in a higher interest rate market. Both are great options, but with the property investment option, if you give that another 10 years, you're just way better off.
Absolutely. What's the downside? What are the risks of this versus the revolving credit?
The biggest risk is with the revolving credit method, it's a guaranteed return. So you know for sure that every dollar you put towards your mortgage, you're getting a return. With property investment, we can't forecast the cycles. There's really good data for the last 100 years in New Zealand as to what happens when you just let inflation do its thing and devalue your debt and property. But we can't guarantee that. So that's the main risk. Property investment does have inherent risks. You've got vacancy risks with your tenants. You've got tenants might wreck your property.
Have you got an example, a real world one, where you've seen this go wrong? The pitfalls that you've seen or heard of someone falling into?
People over leveraging.
Yeah.
Or just people not being patient. Property investment is really easy when you give yourself a lot of time. And it works really well when you give yourself a wide berth and a long investment horizon. But when we see it not working out for people is when they don't have that long-term vision, purely a short-term speculative play. You're just never going to be happy unless you're a calculated property trader who knows exactly what's going on and you're putting all your time into it. Passive long-term buy, hold investing is the best way to build wealth, in my opinion. We're going to go to the last one, which is my favorite, and it's super trendy right now.
Oh,
it's incredibly trendy. The reason it's trendy is because interest rates are dropping, right? We've been in this period now where we've had higher rising rates for about 4 years, and now they're coming down. So we're finally able to give some really good news to our Blueprint clients who are listening that rates are coming down. Jumping into our next sheet, where you can actually pay off your mortgage quicker by doing absolutely nothing. Like I said, Rory, can't get enough of this method. Just cannot get enough. In all our fixed rate reviews at the moment, clients who are coming up for their review, I'm always pushing to see if we can keep the repayments the same as interest rates drop. We'll look at our couple here, 800K mortgage, again, 6% rate, but we're going to make an assumption that the rates dropped to 5%.
nice. Disposable income.
I mean, that's what you'd think. That's what you'd think.
Absolutely.
But I'm trying to say, let's not change the repayments, because every single dollar that you put towards that extra repayment now is going towards your principal. So if we just look at this example here, let's say that the interest rate drops to 5%. Now, you would have seen here the scheduled payment has dropped by $501. So let's take that $501 and put it towards the principal. This is monthly repayments, by the way. You can see here the repayment term has reduced to under 24 years. So we've shaved off
6 years plus.
1% interest savings.
That's an easy method. Providing you're pretty comfortable living with the 6% interest rate repayment, which we assume we are. This is a first home buyer on 6%.
But my favorite thing is, look how much interest you're saving between the difference. So $569,000 interest here is what you pay over the life of the loan. If I take it out, what's that? Almost an extra $200,000 in interest that you're going to pay.
It's incredible, isn't it?
Just that compounding interest because you're not paying it off quicker. So that's a bit of a superpower, actually paying off your mortgage quicker. But those are the only real 3 ways that you can achieve something like that. Obviously, there's many ways within that you can do it, but I suppose just want to let our clients know whenever you guys hear those sorts of things from advertisements or media talking about how you can get your mortgage paid off in 7 years, 10 years, these are the core ideas. And we think the 7 to 10 year time frame is probably a bit unrealistic. But if you had a chat with us when your fixed rate comes up, we can give you guys the ideas and give you specific tailored advice as to how to actually achieve that.
Yeah, absolutely, Dan. No, it's been really interesting, and I think we could probably title this episode "The Things the Banks Don't Want You to Know." Dabbling in all 3 would probably be a pretty successful outcome for most
Wealth
clients.
building exercise.
Yeah.
Absolutely agree. What was your favorite?
Investment property, 7 years, mate. Yeah. I think they're all really good. The revolving credit's fantastic in terms of you're a first home buyer, putting away a bit of security, but at the same time reducing interest. It's fantastic.
Absolutely.
And then taking advantage of interest rate drops, as we've just talked about, is powerful. That's a $200,000 saving in this example alone.
Just by keeping your repayments.
And really achievable. And then obviously the next level is an investment property, I think.
100%. I think the investment property comes once you build a bit of equity. It's a great wealth building long-term tool. You just need to make sure that what you're actually getting out of it aligns with what you're buying. So that's why it's so important to chat to an advisor or even just a property mentor.
Awesome, Dan.
Thanks so much for joining us on this episode. We really appreciate you guys listening, our existing clients, future clients, and our referral partners. Thanks so much for your business and supporting Blueprint. We love taking care of you guys, and we'll see you on the next episode.
All right, we're going to go do our day job now.